Hi there, welcome to Kneppy's analysis. In this video, I am going to discuss Santos. This company has been on the ASX since about 1970, if I remember correctly. And during the time I have been investing on the ASX, which is well over 10 years ago, I have actually been a Santos shareholder for a very small period of time. In fact, that period of time was about 6 months back in 2017. And I'll talk about why I took a position in Santos later in the video. Now, for those who don't know, Santos is an energy company on the ASX. They sell LNG, oil, gas, all those sort of wonderful things, which means Santos is a mining company, which also means, in my opinion, this is just my opinion, Santos is a low quality company, just like every other mining company in the world. And the reason behind that is because they are a price taker, not a price maker. If you don't know the difference between those two, just leave a question in the comment section. Maybe I'll do a video on the difference between price makers and price takers. So let's get stuck into the video and discuss Santos. Now, for full disclosure purposes, even though I have been a shareholder of this company in the past for about 6 months, I am not a shareholder right now. Santos is an energy company. I will say they are geographically diverse. I probably would prefer them to be a little bit more geographically diverse, but they do have production from 5 asset hubs. I don't think the North America asset is in production just yet, but due to their merger with Oil Search, they have a fairly big project or fairly big projects in Papua New Guinea. They also have projects in Timor Sea, a place called Baja Undan, which I actually do forecast for. They're sort of like an oil rig there, that sort of thing. Also have projects in NT, the Betaloo Basin, South Nicholson Basin, Amadeus Basin, offshore of West Australia, Cooper Basin, also projects in Queensland and New South Wales. They classify themselves or call themselves having a diversified product mix, 56% LNG, 29% domestic gas, and 15% crude oil and liquids. And I'm just I just went through their annual report because this company reports in American dollars, which means also that their financial year is the same as their calendar year. So they finished their financial year on December the 31st and released their annual report in February or March, something like that. Just went through this report, and on page, I think it's page 29, they talk about a restructuring in the business. And through this restructuring of the business, they have transitioned the business into 2 divisions: Upstream Gas and Liquids and Santos Energy Solutions. So Upstream Gas and Liquids is composed of Santos's 3 LNG projects, 2 Australian domestic gas businesses on the west and east coast, while Santos Energy Solutions is their transition business to a cleaner energy future and compromises the development of low carbon processing of their third-party gas and liquids, decarbonisation and carbon management services, and clean fuels production. They also mention outside those 2 divisions is their Alaskan Net Zero Scope 1 and 2 emission development project. I have no idea what that is. If you do like what you hear in terms of maybe their Santos Energy Solutions, you're one of those people who wants a cleaner energy future, maybe have a look at their one of their presentations or their annual report to get more of an idea about what they are doing and planning for the future. Another thing I like to do for all mining companies is just to have a look at the reserves at the end of the financial year, because a company's reserves, or more a mining company reserves, can increase or decrease. Naturally decrease because of production and possibly increase because of exploration. So these are the reserves for Santos at the end of financial year 22, so 31st of December 2022. And they have those 5 assets that are in production, plus that 1 asset in Alaska. That 1 asset in Alaska is only crude oil, 90 million barrels of crude oil, but the majority of their reserves throughout their producing assets are in gas, petajoules. So PNG, 2,206 petajoules, Queensland and New South Wales, 1,000 petajoules, and Northern Australia, Timor-Leste, 1,268 petajoules. Down the bottom, they have approved reserves reconciliation. And in this, you can see in the third or fourth column, production. So their reserves decreased because of production, also revisions and extensions, but nothing here about exploration. So have a look at their annual report, have a look at their reserves, have a look at what they're doing in exploration. You get an idea how this company is preparing for the future. The CEO of Santos is Kevin Gallagher, and he's been in this role as a managing director and CEO since the 1st of February 2016, so just over 7 years. And he joined as the CEO of this company during troubled times for Santos. You'll be able to see those troubled times when we look at the chart later in the video. And this is about a year before I took a position in Santos, as they were turning things around, which may have been as a result of Kevin Gallagher. And maybe that's why he's still in this role, because he's highly thought of. I haven't really dug into how Kevin Gallagher is thought about in the mining industry, but because he's been in this role for 7 years, because he did turn Santos around, maybe he's highly respected. He does have an extensive career in oil gas. I don't think he's Australian, because it does mention here that he immigrated to Australia to join Woodside in 1998, but he also has experience as CEOs, a company called Clough Limited from 2011 until his appointment at Santos. Now to the quality of Santos. And first thing you have to know, this is a mining company. Second thing you have to know is that for all mining companies, I automatically give them a low quality because they are price takers. That's no different with Santos. But when it comes to mining companies, there are going to be higher quality and lower quality mining companies. For instance, I probably would put BHP towards the high end of the quality spectrum, mining quality spectrum, and most mining exploring companies on the bottom of the mining quality spectrum. Where does Santos fit in that? Now, based off the last 10 years of history, so look at revenue growth. In fact, it's negative 2.2% per year, but that has improved over the last 5 years up to 9.9% per year. Return on invested capital, okay at 9. In fact, return on invested capital and return on equity are at 15-year highs. So it does look like this was a really good year. Financial year 22 was a really good year for Santos when you just look at the return on invested capital and return on equity. Valuation metrics make it seem like Santos might be really, really cheap. And that actually does scare me a little bit because usually when you see mining companies seem really, really cheap, that is a value trap. So the market doesn't think this company will have quite a good year in 2023 as they experienced in 2022. The market expects earnings to decrease, and that's why the valuation metrics look pretty damn attractive. And we'll have a further discussion of the valuation metrics later in the video. EV to EBIT at 6.5, and that is quite low. Now, the total return. So this includes share price appreciation or depreciation plus dividends. If you've been a Santos shareholder over the past 10 years, since 2013, you have had a negative return. One of the only top 100 companies on the ASX, I have done a little bit of research on this, not many companies in the ASX 100 have given their shareholders a negative return over the past 10 years. And Santos is one of those companies, a negative 2.5% total return over the past 10 years. So that in alone should make you understand why I would probably consider Santos a low quality company. Mining, negative total returns over the past 10 years, revenue growth less than 10%, return on invested capital, return on equity. Well, return on equity actually is above 10, but return on invested capital at a 15-year high, it's still at 9. And valuation metrics probably the only thing going for it. But again, I'd say that is probably a value trap. Now, a few facts in regards to Santos, listed on the ASX June 1970. So as a listed company, this is older than me. I was born well after they listed on the ASX. And all these numbers are from May the 9th. So for instance, the share price, when I looked at it May the 9th, just before market did close, was trading at $7.25. Company has 3.3 billion shares on issue, which means a markup of $7.25 is about $24 billion. The other thing to take note is that since 2013, shares on issue in Santos have more than tripled from 967 million to 3.3 billion. Some of that may have been because of the merger with Oil Search, but you do have to take into account that this company has significantly increased the shares on issue, particularly when you look at the chart. So even though the share price might be significantly lower than, say, 2008, 2013, the valuation of this company might be actually higher because the shares on issue have more than tripled in the past 10 years. Now, I've already mentioned that this company reports in American dollars, but these are in Australian dollars. I have converted them. Revenue, $11.5 billion. Profit, $3.1 billion. So remember, the market cap of this company is around about $24 billion, which means the PE ratio of this company is less than 8. And right now, I can hear you running out and buying Santos shares because a PE ratio of 8 is ridiculously cheap. But again, I think the market is pricing in an earnings not a downgrade, but a decrease in earnings in financial year 23 for this company because what they're selling is decreasing in price. Operating cash flow significantly higher than profit, 6.8 billion. Free cash flow, 4.2 billion. So price operating cash flow, price of free cash flow actually lower or less than 8. In fact, they're around 6 for the free cash flow or price of free cash flow. And I've already mentioned return on equity and return on invested capital are at 15-year highs. Last time they were this high was back in 2008. Another thing I like to see when a company does report is a breakdown of, particularly if they have different divisions, different segments or whatever, a breakdown of the performance of their different divisions or segments. Santos have done that. They've broken down their segments into their assets. For instance, Cooper Basin, Queensland and New South Wales, PNG, Northern Australia and Timor-Leste, and Western Australia. They also have a corporate section here. So I just wanted to see how these different segments, different projects, assets have performed over the past year. And by far, the best performing asset is the PNG. And if I remember correctly, most of that asset is because of that merger with Oil Search. If we go down to the bottom, EBIT for the company as a whole was around about 3.2 billion, and 2.3 billion of that came through from their PNG asset. The next best performing asset was Queensland and New South Wales, and then we had Northern Australia and Timor-Leste coming in third place, and then in fourth place, the Cooper Basin, and then in last place is Western Australia, not including corporate. In fact, Western Australia asset had negative EBIT. Now let's have a look at Santos's revenue and gross margin history since 2013, so 10-year history. I've already mentioned probably the lowest ebb in Santos's past 10 years was around about 2015-16. Can definitely see that in the revenue. Revenue went to a low in 2015, 2.4 billion. Started to rise in 2016, 2.6 billion. But 2016 probably was a worse year for this company. They had revenue of 2.6 billion, but gross margins actually fell from 23% in 2015 to 17% in 2016. But since 2016, we have seen revenue and gross margins improve every single year. Well, not year on year, but it definitely has improved. In fact, revenue has risen to 7.8 billion and gross margins up to 50%. Now, I'm not sure exactly why revenue has increased significantly in the past year from 4.7 billion to 7.8 billion. Maybe it has something to do with the merger with Oil Search. I can't quite remember when that merger came through, but it could just be because of increasing prices in oil and gas, that sort of thing. So overall, you should be able to see that this is a typical mining company where you see revenue ebbing up and down through time because they are price takers. Another way we can tell whether a company is high quality or low quality is just by looking at the dividends. If you see dividends continually climb from year to year, that's probably a good sign a company is pretty high quality. But if you see dividends going up and down, like Santos's, that's probably a pretty good indication that a company is not high quality. It might be a mining company, and some years they have really good years because the price of the commodity is high. Some years they're going to have a really bad year because that same commodity is at a really low price. And when you look at dividend history for Santos, you can definitely see that 2016, 2017 were pretty bad years. They were starting to improve in 2017. In fact, they had no dividend in 2017, very low dividend in 2016. As they started to come out of this lowest part of their cycle, they did issue a dividend in 2018. And since that, dividends have been climbing up until the most recent year, and the most recent dividend is the highest dividend they have given back to the shareholders in the last 10 years. Dividend yield 4.7%. But again, I think the market is concerned that earnings will decrease for Santos in financial year 23 because, well, right now, price of oil and gas is actually falling. So if it keeps on falling or remains at these levels, definitely Santos won't have as good a year as they had in financial year 22. Now to some valuation metrics, and I'll be honest with you, when it comes to valuation metrics for low quality companies, I don't look at these quite as much as high quality companies, because when it comes to high quality companies, I want to buy those companies at good value. It doesn't have to be really low value, just good, fair value. When it comes to low quality companies, sometimes the value is not quite as important as sentiment and trend, particularly sentiment. I want to see some positive sentiment before I take a position in a low quality company, regardless of a valuation. Now, PE ratio 7.7 for Santos right now. Price to sales ratio 1.2. Price of free cash flow 5.7, which is on the low side. If I see price of free cash flow less than 6, I will take an interest in the company and do more research on the company just to see if there is a possible value trap. And I think there is a possibility of a value trap here with Santos. Just because, again, probably mentioned this 3 or 4 times already in the video, I think the market expects earnings to decrease in this financial year. Also did a reverse DCF based off the free cash flow, and to justify the current valuation, free cash flow would have to decrease at 7% per year. So again, this is sort of proof that the market is expecting a decrease in earnings. In fact, I think the market believes that financial year 22 was probably the best year this company is going to experience over the next 10 years, just like this was the best financial performance this company has seen in 15 years. Now, one thing I do like to do is just look at a valuation metric right now and compare it to that valuation metric for the company over a certain period of time. For Santos, that's since 2016. Why 2016? Well, 2016, this company was not profitable. So they should say this is price of free cash flow. So it doesn't matter if they were or were not profitable. They actually had negative free cash flow in 2016. So price of free cash flow was actually negative or zero. So this particular chart only goes back to 2017. So I just want to see how high and how low the price of free cash flow of this company can get. So it can get as high as about 17, which we found or saw in 2018, and as low as about 3, which we found in or during the COVID-19 financial panic. And right now, the price to free cash flow of Santos is towards the low end of the value range or the valuation metric range. Now, that does not mean right now Santos is cheap. I could even argue that when you want to take a position in Santos is when the price of free cash flow is on the high side, at the bottom of the cycle, that sort of thing. So I wouldn't rush out and buy Santos right now just because the price of free cash flow is at the bottom of the range over the past 6 years. It's just telling me, again, for maybe the 5th time, the market is just expecting a worse financial year in financial year 23 and possibly throughout the rest of the decade. Sometimes we can tell whether a company is high or low quality just by looking at the chart. Have a look at any of those best companies in the world like Apple, Amazon, Microsoft. Have a look at the long-term chart. You see the share price going from the bottom left to the top right. We definitely don't see that with Santos. This is Santos's weekly chart over the past 22 years, going back to 2001. At that point in time, I had just moved to Oklahoma from New York. Now, back then in 2001, share price was around about $5 to $6. And then during the period between 2003, 2004, and 2008, the share price of this company went on a massive bull run. In fact, the share price increased by about 4-fold, from about $4.50 up to a high of $18 in the middle of 2008. And that is the all-time high share price for this company. In fact, the share price has got nowhere near those highs since then. Now, the share price went sideways between about 2008 and 2014, but later in 2014, this company hit some bad times. Share price absolutely plunged during 2015. In fact, the share price fell from about $13 all the way down to a low of $2.50. And that low in Santos's share price was in January or February 2016. And who became the CEO of this company? Kevin Gallagher. And he's been in that role ever since. So he was hired, or we could say the company made the transition to a new CEO at their lowest ebb. And you will see that a lot with companies. They will try to change their management when things are just not going right for them. And that was the lowest ebb for this company in January, February 2016. We have seen the share price get as low as $3 since then, middle of 2017, when I actually did take a position in this company. I'll talk about that in the next slide. We also saw the share price get down to $3 during the COVID-19 financial panic. But ever since then, share price has really struggled to get above $9. We saw the share price get to $9 just before COVID-19, and then again in the middle of 2022. But share price is just going sideways right now, consolidating. There is no trend in the share price. It's not going higher, not going lower. So right now, this is a classic example of a share price just consolidating. The bulls aren't in control. The bears aren't in control. No reason to take a position in this company right now. Now, let's go back in time to a 5-year period between June 2015 and June 2020. This is a weekly chart for Santos during that period of time. And we can see the 3 lows in the share price in this 5-year period. In January, February 2016, share price got down to $2.50. Share price got down to $3 in June, July 2017. And then the share price got down to about $2.80, $3 during the COVID-19 financial panic. And remember, the share price low in 2016, January or February 2016, coincided with the transition to the new CEO, Kevin Gallagher. Now, a lot of times when a company gets a new CEO, it can take a while for it to pay off. And for Santos, it was 18 months. And then the company released their quarter report in July 2017. And I still remember reading that quarter report and thinking, this is a really good report. And the market agreed with me. And that's the most important thing. The market has to agree with you when you have this thought about the performance of a company, because it's the market that's going to drive the share price higher, not you. So I did take a position in Santos on the back of that quarter report in July 2017 at about $3.20. But I knew this is not the sort of company you want to own for the long term. And I was happy with just a 50% return. So to get my 50% return in a company like Santos, it only took 4 months because there was a shift in sentiment in this company because of the financial performance in that quarterly report. So it's very important to note that you don't have to own a company for the long term to get a good return. You can hold a bad quality company like Santos. And remember, shareholders who have owned Santos over the past 10 years have had a negative return. But it only took me 4 months to get a 50% return from a company like Santos. And the whole point of investing is to grow your capital. Find any way you can grow your capital. And this is a way you can grow your capital with bad or low quality companies. Just remember, they are not long-term holds. The next 5 companies I want to focus in this series, Kneppy's analysis, are Iris. I've already prepared that video. Fairly interesting company. And then I'll look at Clover Corporation. I do have a to-do list here. So it's Iris, Clover Corporation, Parenti, Mass Group, and then Lycopodium. And after Lycopodium, I'll be looking at AGL for that person who keeps requesting I look at AGL. If you have any companies you would like me to feature in this series, just to leave a recommendation, a suggestion in the comment section of this video. That's all I have for this Kneppy's analysis look at Santos, a company I've owned for about 4 months. I thought it was 6 months, but it was even less than that. And I got a 50% return just by holding for 4 months because of a shift in sentiment. And one of the reasons why the share price rallied by 50% in such a short time was because there was so much pent-up negative sentiment around this company. And when that negative sentiment shifted from negative to positive, that's when the share price can go on significant runs. So I'm always looking at these beaten down companies with the share price had hit historic lows, that sort of thing. And if the company does release any positive news, you can see a significant re-rating in the share price, just like we saw with Santos back in the middle of 2017. So if you have any thoughts about Santos, about their history, about their future, I'd love to hear from you. So leave your thoughts, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.